So I want to talk to you about on a refinance. Some of the things that catch people off guard all the time are the new loan amounts. What is prepaid interest? All my taxes and insurance built in, but what does that all look like? And the payoff. Okay, so why is my new loan amount higher than my old one? First things first, I always talk about this to people right when we start looking at a refinance. The mortgage statement that you have, the principal balance that's showing, that is not your payoff. The principal balance is $690,000. Your loan accrues interest each day, and so the actual payoff of that loan is going to be whatever the principal balance is, plus however many days of interest has accrued. So if that balance is $690, your payoff could be $695. So that's, if you don't want to bring any cash to close, that's where we're going to start your loan amounts. Okay. Then we look at the options. In a high market like this, I encourage people not to pay closing costs, to get lender credits to help them pay the closing costs, because chances are you're probably going to be able to refinance multiple times over the years. And why recycle those closing costs over and over and over again? You can take wins like 6.5 versus 6.25. Both of them are crappy rates, right? So if you can get a free loan at 6.5, still save $300 a month, and then maybe a year later do it again down to 6% or 5.875, having all of your closing costs paid. That's what I recommend. Ultimately, it's up to the client. You know, if you want to put extra money down to buy it down, you know, you might pay $2,000-3,000 extra to buy down a rate. Might save you $75 a month. But if the market dips so fast that you need to refinance again to catch it, that money that you spent up front isn't going to be worth it. So going back to where we started with this, the payoff amount. Payoff amount of that loan, it's going to be higher. I always start there with people because people always get tripped up on this. I don't want to bring any cash to close, but my mortgage balance is $690. It's not. If you paid it off, it's $695 based on our scenario. Now we look at our closing costs. On a refinance, I've got most companies beaten by like $1,500 to $2,000 out the gate before we even look at rates. But when we look at rate, Loan Factor, I believe it's the second biggest brokerage in the country. We've got volume discount power. So we have low rates, very, very strong in the marketplace. I don't charge any processing fees. Most companies charge $600, $1,200. So right there, I'm ahead. Then in section C on a loan estimate, you'll get the title and escrow fees. Well, due to our size, we also have national partnerships, corporate partnerships where we can get discounted title and insurance. $1 million transaction in San Diego County, my section C title and escrow fees, like $950, and that includes a notary, and that's it. That's everything combined. Other companies, they got to work with retail title and escrow companies. You know, those places are going to be $1,500 to $1,800. So boom, right there, I've got it beat by another $600 to $900. So out the gate, I'm already way ahead, and then my rates are better, depending on whether we need an appraisal or not. If we don't need an appraisal, it might be $2,400, $2,500. So even if your closing costs are covered, that new loan amount is going to be around $695 because of your payout. Okay, but then other things that are going to be in your new loan, you're going to have your loan costs, the appraisal paid out of pocket, but I can still give you a lender credit that's enough to recuperate for that. The other part of the transaction is there's prepaid interest, and then whether or not you want impounds, okay? Most times you have to establish a new impound account when you're doing this transaction. So it depends what month of the year it is. Let's say your taxes are $1,200 a month. Your insurance is $200 a month. Well, we need to establish a new account to pre-fund your tax and insurance so that there's enough money in there when it's time to pay them. In a loan scenario like this, that can add, $3,000, $4,000, $5,000 to the financing if you don't want to bring cash to close. Now, what happens if you already have impounds? When we pay off your existing lender, that money that's sitting in that impound account there for you, that is actually your money. That's going to come back to you. They have 30 days to send that back to you. And, it might be $4,000 or $5,000. And, so you'll get that check within 30 days from the current servicer. What do? You don't want to bring any cash to close. You want impounds. So it means that your loan amount is going to go up. But what you can do is, some people really care about that a lot. Some people not so much. But it doesn't have to be a 30-year fix. It could be a 29-year, 28-year, 27-year, whatever it is, whatever you can qualify for and whatever you're comfortable with in terms of the payments and the cost structure. And I go through this religiously with people. It might be a reset of that loan amount. And then when you get that refund from your existing escrow, you can take that money, that $4,000 or $5,000, you can immediately apply that as extra payments on your new loan and take the balance right back down. Now, it might be amortized over a higher loan amount, but because you made that bulk payment, you're ahead on the amortization schedule, and you probably cut off a couple of years technically on that loan, but it takes you back to where you were before. So that's the impound part of it. The last piece is prepaid interest. Your current loan accrues interest until the day that it's paid off. Your new loan accrues interest on the day it's funded and moving forward. So that prepaid interest section on the loan estimate, that is a total moving target, and you don't know what that's going to be really until the end. I mean, we can generally estimate when your closing schedule will be, but what that does is the day your loan is funded through the rest of the month, you collect interest for that many days. It allows servicing to get set up with your new loan, and it allows you to skip that first mortgage payment. You're not actually skipping it, the interest, it's prepaid. But when you make a mortgage payment, let's say for the month of July, you're actually paying off the interest that accrued for all of June, plus a little bit of principal. And then when you make an August payment, you're paying off all the interest that accrued in July, plus a little bit of principal, and so on. So when you build in that prepaid interest, let's say the loan funded on the 15th of the month, there's going to be 15 or 16 days of prepaid interest built into that new financing. Let's say that is May 16th or May 17th, and you've gotten 15 days of prepaid interest. Your first mortgage payment is not going to be due until July. In the financing, prepaid interest, there'll be 15 or 16 days worth of interest at your new rate based on the loan amount, the daily interest per diem. So all of these factors come into play when we're making a new loan amount. Even if your loan costs are completely paid for, if you want impounds, I mean, your loan balance could be, your new loan balance could be going up a fair amount. And again, some of that stuff resets. You can get those old impounds back, immediately pay down the balance. But you can also set it up where you bring cash to close as well. Your taxes and insurance, you're going to pay those things anyway. Maybe you don't need them in the loan. A lot of times the higher balance loans, because the taxes and insurance are so high, people who are comfortable with those higher payments anyway, they elect to pay their tax and insurance on their own, and so that they can do whatever they want with that $10,000 to $15,000 to $20,000 that they would be otherwise committing towards their mortgage. However they want to utilize it, however they want to maximize that money, they'll do that. So if you cut out the impounds, it can keep your balance lower. And then all we have to really worry about is the payoff and the prepaid interest. But again, if your current balance is $690, but your payoff is $695, I'm going to show you that. Say, hey, you want to set your loan amount for $695? We can do that. The only thing is, then you're going to have to show your bank accounts and you're going to have to bring money to close it or wire money in. So it's really not that big of a deal. Some people don't want to show their bank accounts at all. You got a lot of money moving around, whatever it may be, because if you have money moving around, then we have to source it. But I like to do things as easy and smooth as possible, but we talk it all out, make sure it's best for the client. And then from there, we just execute and finish it off. So that's a little more about loan amounts, and it's a common thing that people kind of run into. So appreciate your time. Look me up, www.greatrates.io, and look at my reviews too. I treat every client as if you're family. I want it to be the best mortgage experience you've ever had. I mean, people don't like doing mortgages, right? So I try to make it as easy as possible. I try to teach them as much as possible, and I'm as transparent as possible. And I've cut out a lot of fees. I've cut out the margins by joining Loan Factory. I can pretty much smoke the competition out there, and the whole package of experience, execution, knowledge in the weeds, how to work with underwriters on tougher situations. It's just really, 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 really hard to beat. So thanks so much.